First of all, thank you very much all, especially for MPOC, to invite me here to speak in front of all of our honored guests. Thank you very much. So my presentation will focus on Chinese visual supply and demand outlook. So pretty much I'm going to divide my presentation into three parts. The first one is on consumption, a bit of macro picture, a bit of consumption on the Chinese visual market. And then I will briefly go through the supply situation of the Chinese visual market. And then at the end, I will brief the supply and demand. Basically, I combine supply and demand to brief the surplus and deficit situation of the Chinese visual market, and then come up with conclusions. Okay. So just first of all, very briefly, introduce my company. Maybe many of you guys haven't heard about DCTP. With Engelhart Commodity Trading Partners. We found our business in 2013. We started as under the name of BTG Pactual Commodities. It's a commodity division under the BTG Pactual Investment Bank in Brazil. And then this year, 2016, we changed our name to ECTP, which is our current name, basically due to a shareholder change. Currently, we have globally 18 global locations and 34 offices. We have over 800 employees. And the products we're trading covers pretty much most of the bulk commodities, starting from metals, minerals, energy, and as well as agricultural products. Okay, so firstly, like I mentioned, very briefly to brief all of us the basic effects of Chinese market, Chinese visual market. So it's as we all know, it's the world's largest domestic consumer, China, and also second largest visual importers after India. It's 35 million metric tons of market, and out of that, 7 million tons coming from imports, 5 million palm. However, the supply side, as you can see, out of the 35 million tons of demand, supply mostly coming from crushing oilseeds, both soybeans and rapeseeds. And in terms of palm, 100% are imported to fill up the elastic gap of the visual deficit, as well as to meet the inelastic demand of the Chinese visual consumption. And the two characteristics of the Chinese market in terms of marketing channels, branded oils in the packaged oils basically now dominates the overall consumer marketing channels, and also bulk market is very well developed, especially for recent years. We developed a lot in the forward market, for the cash market, and basis pricing contracts, etc. So take a look at the Chinese per capita visual consumption. So the first chart is China consumption per capita versus per capita GDP, and the second is I think is the most comparable region is Taiwan. So I think two can be compared. Being the closest two regions to compare. So Chinese per capita visual consumption currently is around 24 kg per capita, versus the per capita GDP around $8,000 US per capita. And interestingly, if you see the blue on the Taiwan side, the blue is the per capita consumption on visual. It actually reached a plateau around 25 kg per capita consumption, and that's actually where China, mainland China, stands at currently. And also, if you look at the per capita GDP for Taiwan, it actually when it reached 25 kg of per capita consumption, it's actually their per capita GDP stands at around $8K US as well. That's where basically where China stands at the moment. So one of the very relevant argument would be is the per capita consumption in China has reached a plateau. Just two more countries to compare. One is Malaysia, similar situation. Consumption slowed in Malaysia after reaching 24.5 kg of per capita consumption. But the other country that is US, which is a bit different. It keeps rising very, very strongly till 30 to 35 kg of consumption. I believe this is mostly due to the dieting habit, different diet habits between Western world and the Eastern world. So a bit of a macro, as I promised. So first, I think this is the most relevant macro picture that macro point that China macroeconomy is experiencing now is the Chinese population is aging. So the chart is basically Chinese population. So overall, we got the 1.4 billion population, and the red bar is the adult share. Green is senior share, and the blue is the youth share. We define youth as the age below 15, and the senior is age below 64. So in 2013, actually, the adult part of the population actually reached the peak. So starting 2014 and 15, it started to shrink actually. What does it mean? It means that despite you have a growth of 0.5% of overall population growth, which is already quite low in the developing world, it means that if you assume the youth and senior population consumes 50% of what an average adult do, your consumption based on only population is actually shrinking in starting 2015. So that's something that I think for a lot of commodities it's very relevant. Then move to the real macro on the GDP. So the blue line is the GDP percentage increase on an annual basis for the past 20 years. And then the red line is the GDP, but in the catering sector, so more relevant to food. So as you see that both are trending, both were stable at very high growth, double-digit growth before 2010, and then they start to trend lower after 2010, basically recent 5 years. The other indicators that can be more real, because a lot of people are challenging that Chinese GDP numbers are not real, but this is something that I would trust the most, is the power generation index. It's a year-on-year index, and you're very lucky you have a quarterly index on this. As you can see, similar picture. 10 years ago, China is growing double digits, but recent 5 years, clearly the growth has been cut by half. Okay, what do these mean to visual demand growth? So the growth on average for past almost 10 years is growing 2 to 4%. And the 2016-17, we forecast, ECP will forecast it will increase 3.6%. This is mainly mainly due to the cheap rapeseed oil supply that's from reserve. So without this cheap rapeseed oil supply, we believe that the growth is going to be much smaller than this. A bit of explanation here, or some other points here. I didn't put on the slide, but so if you look at these points that are starting 2006 all the way to 2009, we had a fairly low growth, but afterwards we had a recovery. Some of these change I contribute to the control of the food health in China, which mainly they take off the control, stricter control in the food health sector starting 2010, carried all the way to 2012. So during that campaign, a lot of the gutter oil was actually killed during those years. So that's why if we look at the real growth, I would say these points should move a little bit up and these points should move a little bit down, just because you're replacing the gutter oil. In terms of the visual diminished share between the oils, so bean oil takes almost half of the demand. Then the second is the rapeseed oil, 20%. Then the third is 15% is palm, and the rest around around the 20 to 30% is domestically produced corn oil, groundnut oil, cottonseed oil, and also some sunflower oil. I would skip a few slides and I will come back later on this. I want to finish up first wrap up the demand sector. So in terms of demand dynamics, it's as you can see in the pie chart here, the mid-pack to bulk business takes more than half of the overall China vegetable demand. Marketing channels. Actually, bulk is actually smaller than the main pack, but by mid pack there's different definitions right now because it's still under development. The growth in the mid pack is very fast, and then the second marketing channel is small pack. Small pack, I think we all know we are all very familiar with, is that it's a very concentrated market already in China, with a few names that very popular. Basically, Wilmar, their Arowana brand. Basically, Wilmar takes about 40% of the overall Chinese small pack market, and the consumers are very recognizing. Their brand basically is very much recognized in China. And then the second place is Cofco. It's roughly 10%. And then third place is Lu Hua, is a local guy who is specialized in groundnut oil production. Like we said, it's a more concentrated market. So for the small pack, it's very tough to compete with the top guys. Then in the mid pack business, it's a lot more players and lots of local small players, and this is where that you can find a lot of switchability between oils. Depending on the price. And also you have some small sectors of small sectors of demand, like demand on farm. This is mainly rapeseed oil. So basically the farmers are crushing their seeds for just exchange for oil, and they consume at home. And also feed oil. It's mainly for soybean oil. And then you have food industry and the Olecam, plus specialty fats. And all these, most of these are for palm. Just to note that, yes, maybe we can go here, then we can move later. On the demand in terms of geographics, what are the differences in terms of demand allocations in China? So northeast of China, mainly dominated by soybean oil. This is because traditionally they produce soybeans and they crush soybeans there. And then East China, soybean oil. And the West China is mainly rapeseed oil. That's where the majority of the local crop was produced. And the rest mainly are mixed oils. Basically, there's no one single dominant oil type. And in terms of palm, so that's something that I wanted to say earlier, but I think it's better to say here. So the mid-pack plus bulk takes more than half of the demand composition, and then you don't really have a big small pack usage for palm in China due to a lot of reasons. And then the other half takes by food industry, which is like instant noodle production, biscuits, cakes, pastry, ice cream, and then you have oleochemicals, and also then you have specialty fats. The specific fats part is actually increasing very fast in China. This is it's mainly for coatings, for Starbucks, for basically this sector is actually growing very fast. And the elastic part is actually the mid-pack to bulk part. So in this part, it's a blend oil in the mid-pack, and actually the usage of it it changed a lot based on the price spread versus soft oils. Okay, so then I go back to the previous ones that we missed. Okay, so that wraps up the demand side of the equation, and let's turn to supply side. So the supply of veg oil, like we said, it's mainly from crushing. Basically, most of the crushing imported soybeans. And then the blue, in terms of the chart, the blue line is the soft oil production, and the red line is the veg oil demand year-on-year increase. Both are relative value. So if you see that there's a gap in certain years. So this means that when the blue goes high, which means that you have a less deficit. When the blue goes low, it means that you have a more deficit versus what you are demanding. And for recent, I would say 4 or 5 years, your production is actually outpacing your demand growth. That's why we're experiencing the decline of the Chinese veg oil imports for recent years. In terms of different oil type, imports of different oil type, for recent 3-4 years, most of them are declining mainly because that two reasons. You have more soybean crushings, crushed for meal, so that you have soybean oil to be consumed, and then you have rapeseed oil getting released from reserve. The only oil that is increasing exponentially in terms of imports is sunflower oil. This is because the Chinese people now start to believe that sunflower oil will give you a better health. Basically, it's healthier. That's why we are importing more sunflower oil, and they can actually charge a premium in China. And the third equation of the supply is the reserve, like we mentioned. This last run, China released 2.3 million tons of rapeseed oil, starting December 2015 until June 2016. And the new round of release actually started today. It's 100K per week. Actually, today it's 100% sold. With the bids was on fire. So basically, you had a pretty decent premium over the floor price. So basically we expect that versus the current stock, the reserve rapeseed oil stock of 4 million tons. We expect that they're gonna significantly keep drawing down to around between 1 to 2 million tons. Then we move to the supply and demand when we combine them together. So when you combine them together, you see that the green line is actually the surplus and deficit. This is taking out the reserve section. So for last year and for expected this year, we have a fairly big deficit. This will be met by the reserve release, and we will go over it later again, since it's quite important. And in terms of palm supply and demand, some years we have a surplus, some years we have a deficit. It depends on economics. This year, basically last year, 2015 and 16, we have a pretty decent deficit, and the consequences for that is that we have a historical low palm oil port stocks at the end of the year. And next year, we expect it to be pretty balanced. Going a bit, closer to last year and this year's the veg oil balances. So you see that this is by oil type. The red bar is the demand, blue bar is supply, and the green is the supply minus demand, and the purple bar is the rapeseed oil release. So the key point is that 15, 16, you see this green. It's actually, we are having pretty big deficit in terms of oil, so 2.5 million tons, and most of them are met. More, it's actually the release or more than offsetting the actual deficit. And for next year, we are projecting a deficit, a small deficit, 500,000 tons. However, this purple bar is 1 million tons of release that we think minimally it's going to happen. So this creates a huge, at the end of the day, create a pretty decent surpluses for 16, 17. However, I wouldn't call it a real surplus because of the behavior of the Chinese rapeseed oil players in China. A lot of end users, are involved, and a lot of speculators are involved in buying the reserve rapeseed oil, which made them actually not that liquid in terms of movement. So we have to be very careful considering these oils when we do market analysis. Okay, in terms of stocks, we've covered a bit. So 15, 16, we have a stock drawing down, and 16, 17, we expect the stock going to be up by almost 1 million tons. This is mainly from rapeseed oil. Stocks in the monthly chart, I'll skip that. And then in terms of conclusions, market functions, for the first two charts are soybean oil import parities, and the second, the bottom two charts are soybean crush margins. Soybean import margins are deeply negative now, which I think it makes sense because China basically don't need import soft oils. And the crush margins are pretty okay, historically speaking, for the current level. And I think it's going to keep bringing more beans for crush and bringing more soybean oil supply, which I don't think anything is wrong here. And the second sector on the palm is what we see is the first one is the Chinese palm oil business, cash basis. You've seen the basis has gone up to historical high that to a level that you would not imagine before. This is basically because of there was the import program was too low, that the stocks getting too tight, that actually a lot of places are getting squeezed in the cash market. So you have this huge cash basis, but it's started to go softer recently. The second chart is the palm oil import margin. Currently, it's within money. When I made this presentation, it's still out of money, but given the recent behavior of the Indonesian plantations, it's now start to be within parity that China start to buy more palm oil recently. And we believe that for the Q4 program, China is more or less finished. So for this, what I wanted to say is that for palm, you always need the parity to go positive from time to time. Otherwise, you have situation like this year. Then inter-oil spreads, it will reflect the inter-oil fundamentals, but it's getting trickier again because of rapeseed oil. So you would say that you have a lot of rapeseed oil coming out of reserve, but actually it's tricky because actually, like we mentioned, the rationale is that a lot of speculators are actually holding it just for the sake of holding it. So the liquidity of these oils are not going to be easily move out if the price starts to drop. And then color spread implication. This is fairly easier with the current outlook of the Chinese federal situation. We think that all the color spreads should be in carry, if not in full carry. So I think that's all I want to share today. Thank you very much.